and welcome to Fridays with Vistage, the latest in our series to bring you Vistage speakers to your office so you can enjoy what they're telling us along with everyone on your staff, and we can really give the benefit of Vistage to a greater preponderance of the people who you work with. Today we have got not only is it a tremendous topic, the fastest way to improve cash flow, which we're all interested in right now. But I want you to pay attention to all of the Vistage webinars, of course. Dr. Lisa Lang is with us today, and she's going to discuss the theory of constraints approach to increasing cash velocity. Now, what she's going to be going through with you here is a different way of looking at how cash gets into your business and runs through it. And she's going to be going through some slides that are technical from a numbers standpoint nature, so you're really going to have to keep your eye on the screen during this one. All of them have been great so far, but this one you're going to have to be especially careful to watch the numbers she's going through, because it will make sense, but you got to watch carefully and you're going to get some great insight. Let me tell you about Dr. Lisa, as she is known. The name of her company is The Science of Business. She's the president of the consulting firm. She has got a tremendous background. Not only does she have a PhD in engineering, but she also has worked in corporate America in a number of different roles: operations, strategic planning, purchasing for Clorox, Anheuser-Busch, and Coors. She also worked for, I think, 4 years with Dr. Eli Goldratt. He is the author of the tremendous book, The Goal, and this is where he introduces the theory of constraints. And Lisa has a tremendous background, and what you won't be able to tell by the sound of her voice is that she also got through college on a softball scholarship. She's not only a tremendous shortstop, but she's also a great catcher. So with that, Lisa, it's now in your hands. Take us through the theory of constraints in improving our cash flow.
Thank you, Mark. Thanks for that great overview, even of what's to come. So we are going to talk about how to increase cash flow, and what I'm going to go through is I'm going to give you a very brief overview of theory of constraints to sort of outline what I'm talking about as far as focusing on the constraint. What does theory of constraints mean? And then we won't spend much time on that. We're then going to transition in focusing on a cash type of constraint, and I'll talk about what's the real story? How much cash do we really need? And I think you'll find some surprising information in that if you use traditional techniques, you don't always see the real story. So I'll talk about traditional techniques and then compare that to what I'm suggesting that you do so you can see the difference. I'll also talk about how long does it take us to generate the dollars, the cash. So it's one thing, the amount of cash, but the other piece of it is how fast can we get it. And then, of course, we'll end up with what is the fastest way to increase cash flow. So I'll build to that, and we'll get to that at the very end. But let's go ahead and get started with an analogy of what is theory of constraints. And for those of you who've heard me speak in my Maximizing Profitability Vistage presentation, you've probably seen this chain before. And let's say that the goal of this chain is to hold the maximum amount of weight possible. And in order to hold that weight, we have interdependency between these links, which means that this chain represents a system. It's a simple system, but a system nonetheless. And of course, our organizations are systems with slightly different goals. But we run them very similar to this chain analogy. The way that we run our companies typically is we break it up into pieces, and we give each person responsibility for a different link in the chain. And we're going to do that here with this chain. Let's say that each of you have responsibility for a link in the chain. Well, typically you take your budget and you apply it to your specific link in the chain. And let's zoom in here on a couple of these links. And despite the fact that you all have your budgets and you have to just work on your link or your silo, there still is one weakest link in this chain. And that's really what we call the constraint. So despite the budgets and the political stuff that might be going on in your company, really the only time we have an impact on our goal to hold more weight is when we strengthen the weakest link. And in our organizations, of course, we have a slightly different goal. We don't talk about the weakest link, but we talk about making more money as the goal. And the weakest link in that case is something within our organization. So when we're talking about theory of constraints approach, a lot of times we're talking about the one thing we should be focusing on, and that's this weakest link or the constraint of our company. So if the weakest link in a chain determines the performance of the chain, how much weight we can hold, then the constraint of our company determines what? And of course the answer is the performance of the company or how much money we can make. So you have a constraint now, you may or may not know where it is, and it will determine how much money you can make. So if all that's true, then for us to maximize our profitability, we must focus on and leverage our constraint. And so this is basically the one thing we should be doing. What's the one thing we should be working on tomorrow when we come in? Well, that's dependent on what's your constraint. So when you understand constraints, this concept of the constraint, it's not an 80-20 rule, it's really a 99-1. What's the one thing we should be working on? And that's what theory of constraints can help you do, is focus on the one thing to have the biggest impact on your bottom line. So typically when I talk about constraints or bottlenecks, most of us are used to dealing with operational type constraints. We're used to certain types of constraints within our operation. We can't seem to meet customer commitments or whatever those typical constraints are. But in a time of a recession, the constraints can tend to be a little bit different. For example, two common constraints I'm hearing about now are cash and either the market or a sales constraint. And what we're going to focus on in this webinar is this cash constraint. And this is really important because if you have a cash constraint, you're not far from going out of business. And we'll talk about that as we go on. So we're going to focus on probably this most important one for surviving. And once we can make sure that we are surviving, then what you would do is probably focus your attention on this market constraint. So let's see how this works. I want to give you essentially the real story. The real story, by that I mean, how much cash do we really need? How do we get this real story? And to do that, I need to give you some definitions because, as I said, what I'm going to present is slightly different than what we've been taught. So I'm going to give you a couple of definitions so that we can have a conversation about how to get to these real numbers. So the first definition is called operating expenses. Now when I talk about operating expenses, these are all the fixed costs that typically do not change when we sell one more of our product or service. So I sell one more of my product or service and these costs don't change. You know, whether I sell one or I sell nothing, these costs are really the same. And they include things like labor, utilities, maintenance, warehousing, manufacturing costs, general administrative expenses. I sell one more of my product or service, and these costs don't change. And notice the definition has to do with selling one. The other thing about operating expenses, if I triple my sales this year, these might go to a new level. But my definition here, when I sell one, they don't really change. If I sell 3 times as much, yes, they'll go to a new level. But notice the definition is if I sell one, they don't really change. The next definition is what we call truly variable costs. Now these are the costs that vary by the one. So these are the costs that when I sell one of my products or service, I either have or will have to pay for these. So when I sell one, I have to pay for these. And these are things like raw materials or purchase parts. They can include outside services, sales commission, freight. These are the costs that I have to pay because I sold one. And I don't sell one, I don't pay these. They vary by the one. All right, so let's see what that means compared to what we're taught to do. And what we're taught are called generally accepted accounting principles. And in today's constraints, our version of this is called throughput accounting. Now, in generally accepted accounting practices, labor is part of your cost of goods sold. What I'm doing here is separating out those truly fixed costs, the operating expenses, the costs that don't change when I sell one, from the costs that I have to pay because I sold one. So let's look at a typical P&L, and I think you'll be able to see the difference in definition here. So on the left here, I have a typical P&L statement. So I have the sales minus cost of goods sold, and included in this cost of goods sold for most of us at a minimum are some allocated costs like direct labor. And some people might even allocate other things up here. So I have the sales minus those cost of goods sold gives me my gross profit. And then I subtract my selling and general administrative expenses, what those fixed costs tend to be, and I get a profit in this example of $300. Now on the throughput accounting side, if we were taking the same numbers and using the definitions I just gave you, I have sales of $12,000 minus truly variable costs of $5,700. that gives me a throughput of 6,300, and the operating expenses are 6,000, and the profit, again, is 300. So we have the same profit. The answer here is the same. But here's the big difference. In this operating expense, I leave labor down here. So I have the sales minus the cost I have to pay because I sold one. And again, these are things like the raw materials, sales commission. If I sold one, what I had to pay as a result of selling one, that's what I've got up here in the truly variable cost. And the difference is throughput. After I get the throughput, then I subtract all my operating expenses, and then I get the profit. So that's the big difference in definition. Now what we're going to do is transition to talking about, well, what's break-even? And what's going to be surprising is you're going to see that break-even is essentially different when we look at either one of these. So break-even tends to be when I can generate enough gross profit to cover these fixed costs here, in this case selling and general administrative expenses. In the other side, break-even is a little higher. It's $6,000 versus the $4,983. So break-even and the cash we need is going to be different. I'm going to show you that here on the next slide. So break-even is when we meet these fixed costs. And notice that the fixed costs in each case are different. And these are the period costs that we have to pay, depending on the period we're looking at here, every month, every week, every year. These are the fixed costs we have to pay. And notice how, depending on which definitions you use, the answer is different. Okay, so now if we take those numbers and we back into what sales we need for break-even, also notice that the sales numbers are different. So here's the break-even, and they're different in each case. And the cash we need is also different. So the cost of goods sold, or what I call truly variable cost, notice are different. And that's the cash we need for the sales in the period. So every time I sell one, on the traditional P&L is telling us for however many I'm planning on selling in that period, I need $63.42 in cash. On the right side, it says, well, for whatever I'm planning on selling in the period, I need $54.29. How can they be different? So this is pretty interesting. Also notice that the period costs are different. So what we've discovered here is that the real cash story is actually different than what we get from our traditional P&Ls. If you're using P&Ls to determine how much cash you need, very likely it's not real. Those are not the real numbers. And if you're close to becoming a cash constraint, if your cash is tight, that's a pretty scary scenario, to not have those true numbers. So, Mark, I'd like to pause there for any questions that people might have. I know you have a list of questions. What questions do you have there in front of you that might be appropriate given what I've just described?
Well, I've got a few.
Okay.
When you say labor, could that be is that including both your own employees as well as any sub that's just labor, not materials oriented, or are all those the same thing?
Okay, that's a great question. So it depends on how you use the labor. So if it's labor that actually comes in and performs a specific task, and then when that task is done, leaves, then I would call that truly variable cost. They're coming in to do one thing and they're leaving. If it's labor that really is there all the time, then I would treat it more like employees.
Okay.
So let me give you an example. So let's say that we sell something and we hire somebody to do one specific component of it. So let's say that we make signs and we're going to hire outside of our company somebody to go and install the sign. That would be a truly variable cost, that installer.
Okay.
If instead, though, we didn't pay that installer just for that one sign, we said we're going to pay you to be available all the time, I would put it in operating expense.
Okay. So could you give us, and then after this I want you to get back to your presentation, could you give us a 2-sentence headline of the difference between throughput accounting, based on what we've seen so far, and our normal P&Ls, which we've been living with forever?
Yes. In throughput accounting, we do not allocate.
You don't differentiate, you don't allocate.
We don't allocate. Okay. We say we're going to take our sales dollars minus the cost we have to pay because we sold one, and everything else is considered operating expense or fixed cost. We do not allocate out of operating expense up to those truly variable costs. So there's no allocation.
All right. Well, it takes a while to get your arms around this, doesn't it? This is different.
Yeah, it's a little counterintuitive. It is different than what we're taught. But what's really interesting here is that if we are concerned about cash, we're not getting the true story with traditional methods, which is a little scary.
Definitely. Okay, please proceed.
Okay. So when we allocate, break-even is more difficult to determine. You know, what is the real break-even number? Is it the 4983 or is it the 6,000? And the cash we need is not accurate. The cash that we need both to generate sales for break-even and to cover our period costs. It's a totally different story. And there's still another negative to allocating cost. It can cause us to pass on opportunities. So let me explain that. Okay, here's an example. A customer asks you to sell an additional product or service, and they offer to pay an additional $15 for a quantity of 100. So $15 each for 100 for this new item. And I did the example two ways. I did one assuming that you actually sell physical products, and one that this might actually be a $15 service.
Okay,
so
great.
If you're selling a product for $15, let's say that your raw material is $4, your outside services are $2, and let's say that we allocate direct labor traditionally of $10 for this. That means that the gross margin in the traditional sense you would say, this doesn't look like a good opportunity. I would lose $1 on each one. Now, if you're a service company, you may not have raw materials or you may not have outside services, but you probably would still have the direct labor allocation. So you'd have the $15 minus the direct labor allocation, and for the service company, you might have a gross margin of 5. And depending on what your target gross margin is, or some people like to target a percentage, if that $5 is not the right percentage, again, you may pass on the opportunity. So this is what we traditionally do when we're looking at, should I take this job or not? Should I add this new product or not? We do an allocation. And with clients I've worked with, this is very similar to what they would do to make the decision. The problem is that this direct labor allocation muddies the waters. We're not going to have to go out and hire any more people, let's say. We're doing it with our existing capacity. And so this labor allocation doesn't give us the real story. Because the real dollars generated in the product example were $9. For every one of these we sell, we're going to generate $9 of throughput. In the service example, for every one of these we sell, we're going to actually generate $15 of throughput. So those are the real numbers. That's what we should be looking at. This throughput in this case is what I'm talking about, the real dollars that we generate. So how should we make this decision? If what I've just explained is the traditional way and that doesn't work, how should we do it? Well, what I have my clients do is I have them ask for every opportunity that comes along, what's the change in throughput compared to the change in operating expense? So how much additional throughput, right now we have 6,300, how much will this go up if we do this opportunity? How many additional more dollars will go up if we did this? And in our example we just did, if you were a product company, it would be $900, and if you were a service company, it would be $1,500. Now, the other side of it is, will I need to hire any people? Will I need to buy any equipment to do this opportunity? If the answer is no, then the change in operating expense is 0. Now, if the answer was yes, then you're going to have a change in operating expense. This operating expense would go to a new level, and all you do is you compare the change in throughput to the change in operating expense. And if the change in throughput is greater than this change in operating expense, if this throughput number, this 6,300, is going to go up and grow faster than our increase in operating expense, the difference will go to the bottom line. So in our example that we just did, if we had a product example and we didn't need to hire any people or buy any equipment to do that, our profit would go up by $900, that change in throughput, because our change in operating expense was 0. Or if we were a service company, $1,500. And that would be a big jump in profit for something that was unprofitable or, through our traditional lens, didn't look very attractive.
Lisa, I need to add something here for those of us in the audience who are neither engineers nor an expert on the Greek iconography. But every time there's a triangle, that's your word for the change in.
Correct.
Okay, sorry to make it simple on us simpletons, but I want to make sure that people are grasping this slide, which is huge. It's huge for the way we run our businesses.
It's absolutely huge. And particularly right now when either you have this cash constraint or you have a market constraint, the last thing you want to do is turn down this additional throughput.
That's good work.
Yeah, one of my pet peeves is when my clients tell me, if I take that job, I'll lose money on that job. Boy, that drives me absolutely crazy. Because that means that you are charging less than your truly variable cost. You're going to charge less than the raw materials cost you. No, that's not correct. By the time you allocate cost, your system tells you you're going to lose money. So what I'm suggesting here is I'm not telling you what you should or shouldn't do. What I'm suggesting is let's get to the real numbers. Let's understand what the real numbers are. How much money will you really generate if you took this opportunity? How much cash do you really need to cover your sales for that period and to cover your period cost? What we're doing today is getting to those real numbers so we can make good decisions.
Great.
Okay, now we got to talk about, we understand what those real numbers are. How long does it take us to generate those dollars? We need to understand our cash velocity. Okay, so what is cash velocity? Cash velocity is the throughput you generate, those real dollars we just talked about, divided by the time it takes to generate them. So you can increase or you can impact cash velocity by increasing your throughput, those real dollars, or decreasing the time it takes to generate those dollars. Okay? So probably one of the easiest things to do is we're going to look at an example here in a second. So cash-to-cash cycle time, which was that denominator, the thing on the bottom, is the time it takes to generate the throughput. That's the cash-to-cash cycle time, or those real dollars. How long does it take us to generate those dollars? And it's the ratio that serves to highlight the amount of time you're financing a sale. Now, depending on the type of company you are, there are different components of your cash-to-cash cycle time. So for product companies, it's basically from the time you spend money on your raw materials until the time you get the money back from the customer, it's that time. So cash-to-cash cycle time includes the process lead time. How long does it take you to process it? Your accounts receivable, how long does it take to collect from your customers? How many days of raw material inventory do you have? How many days of finished goods do you have? And how long do you get until you need to pay? And transportation time, depending on the timing of billing, can also be included in that time. Now, if you're a service company, it's a slightly simpler picture, a little bit different. You still have process time. You still have the time to deliver your service. A customer calls, and there's some time between when you actually deliver your service. And then you also have the components of how long does it take you to collect, and if you do pay for something, if you pay for a subcontracted service, how long do you have to pay? So slightly different components depending on the type of company you are. But it all comes down to is what are the components, how long is your cash tied up in each of these areas? So why cash velocity? So why are we talking about this? Well, if you track your cash velocity, you can better ensure that cash does not become your constraint. That's what's absolutely key, is we don't want cash to become our constraint. Many of you who've heard my presentation know I talk about strategically placing your constraint and how important that is to be able to leverage it. Well, cash is never where we want our constraint to be. So what we're focusing on today is how we make sure that cash never becomes our constraint. Well, first we need to understand the definition of what is a cash constraint. I hear people use cash constraint to say those words, but really, if they had a cash constraint, they probably wouldn't be there talking to me because there's a very specific definition. Here's what it means. Cash is your constraint if and only if you have sufficient orders. In other words, you don't have a market constraint. You've got plenty of orders coming in. You have sufficient capacity to deliver the orders, and you have sufficient vendors to supply the raw materials needed, or if you're a service company, whatever you might need for those orders. And your vendors are refusing to supply on credit, and they will supply only against cash. And you do not have what you need to deliver your product or service, nor do you have the cash to get what you need. So you cannot deliver your product or service. That's the definition of a cash constraint. It is literally keeping you from selling. And most people, when they reach that, they're not there for long, because typically by the time they reach that, they're out of business. So what we want to do today is make sure you get those real numbers and understand your cash velocity so you do not get anywhere near a cash constraint.
Hey,
Mark?
Dr. Lisa?
Yes.
When someone says they're in cash constraint and you spend 10 minutes with them and you realize they're not, what are they really feeling?
Usually it's their cash-to-cash cycle time, their cash velocity isn't where they want it to be. They can't find, they're having trouble, the cash is tight. You know, maybe they had to go against, they could be saying, I had to go against my line of credit. Well, if you have a line of credit, you're not going to hit a cash constraint.
Good. Okay,
that
good.
Kind of thing.
So it's if you're really, the key bullet item here, and please make sure I'm reading this correctly, is your vendors are saying no more.
Yeah.
You give us money or you're not going to get any more from us. That's the holdup here.
That could be, and if you're a service company, it could be more like you can't pay your employees.
I got it. Okay.
And they're saying, hey, I'm not showing up.
Can't meet payroll. Okay,
yeah,
good.
You can't meet payroll. You can't pay your vendors. So it depends on the type of company you are, and it's always a challenge in Vistage discussions because we have so many different types of companies. But it's either you can't make your payroll or you can't pay your vendors so that you can make a product. The net is you do not have the cash to deliver your product or service.
Good. Okay, thank you.
You have a customer who wants to buy, you don't have the cash to be able to do it.
It's over.
It's over. Game over. Yeah, you're probably a week away.
Okay.
Usually when I get this call, it's an immediate.
But I think your point is that when you're feeling nervous or sleepless at night, you're not here yet, but you can see it coming because you're worried about your velocity.
Yeah, worry and get the real numbers.
Okay, great.
So imagine how much better you'd feel if you knew the real numbers and you understood your cash velocity.
Very good.
Because now you can act on it. You know the one thing to focus on. Okay, so let's continue on. And what we're going to do now is I'm going to show you an example, and this will be really eye-opening, I think. So here's the example. And what I'm focusing on here is the impact of cash-to-cash cycle time, that denominator of the cash velocity. So let's say that you could sell a product or service which generates $100 of throughput in 30 days. Or you could negotiate a deal where you generate $85 of throughput in 10 days. So, for example, you're giving a 15% discount, let's say, if they paid in 10 days versus 30, which is, I'm not, again, suggesting that you do that. We're just doing an example here to really understand cash velocity. Let's say that the truly variable costs for this product or service are $40. You have a cash constraint, which means you can only deliver another product or service when you generate throughput. You have to generate some dollars in order to buy raw materials or whatever those truly variable costs are for you to be able to sell the next one. You're starting with $80 in the bank. So which would you prefer, $100 of throughput in 30 days or $85 of throughput in 10 if you were in this situation? So let's look at it. Now, I apologize. We have to get into a little bit of numbers here, but I think this will be, we'll do it like a Band-Aid. It'll be quick and it won't be painful at all.
Good.
All right, so here's the two options. The first one we're going to look at is we're generating $100 in throughput. And remember, throughput is the sales dollars minus the truly variable costs I had to pay. And we said in this example our truly variable costs were $40. So really we had a selling price of $140. But the throughput is $100, and we're going to generate it in 30 days. We said starting in the bank we had $80, which means we could buy two, well, I call them raw materials here just to keep it simple, and that's what I had room for on the slide. We could buy two raw materials with our $80 because our truly variable costs were $40, so we can buy two of those. All right, so we buy two of those, and let's say that we are able to sell now two. Well, after 10 days, we haven't generated any throughput. We have nothing in the bank because we used the $80 to buy two sets of raw materials. After another 10 days, same story. We've generated no throughput, and we still have nothing in the bank. But after the 30 days, we now have generated throughput of $200 because we had two of them, which we can now use to buy 5 more raw materials. And if we buy 5 more raw materials with that $200, our bank balance is still zero. So we go another 30 days. We have, 10 days again with no change, 10 days with no change. But after the second 30 days or 60 days in total, we have now sold those 5. So we've generated throughput of 500, and we have a bank balance of 500, assuming we haven't now immediately gone and bought more raw materials. So we're at the end of 60 days, we're sitting with $500 in the bank. Okay, let's look at the other option. The other option is we have going to get $85 in throughput in 10 days. We still have that same $80 bank balance that we're starting with, and we can still only buy 2 raw materials to start because they're $40 each. Okay, so after 10 days, because we're getting paid in 10 days now, we're selling the 2, but we're only collecting $85, so 2 times 85 is $170. Now we can take that $170 and we can buy 4 more raw materials, but that leaves us, it's an odd amount, so that leaves us with $10 still in the bank. And after 10 days, we then sell those 4, so we generate $340 of throughput, which means now we can buy 8 more raw materials, and we have a balance of $20 in the bank. We go another 10 days. We've now sold those 8. We've collected on those 8 after the 10 days, and we now have throughput of $680. With that $680, we can now buy 17 raw materials, and 40 goes into there nicely, so we have a bank balance of 0. We go another 10 days. We have now collected on those 17 that we had produced, and we now have throughput of $14.45. Now we can take that. We can buy 36 raw materials, and that leaves us a bank balance of $5. After another 10 days, we sell that 36, and we generate throughput of $3,060. We can now buy 76 raw materials, and we have a bank balance of 20. After another 10 days, we are collecting on the 76 we just sold, and we generate throughput of $64.60. And assuming we don't buy any more raw materials at this point, we now have a bank balance at $64.60. So quite a difference. And what this tells us is that the denominator, that cash-to-cash cycle time, has a bigger impact than the throughput dollars that we're generating, which is pretty interesting. Now, depending on what your period costs were, the second choice might be better. So if in that prior example where I said our operating expenses were $6,000 for the period, if the period, let's say, was 60 days, we were looking at a 60-day P&L and a 60-day throughput accounting statement, and we had $6,000 that we needed to pay to meet payroll at the end of that 60 days. Well, this second option is going to get us there because we have $64.60 in the bank. And we're still going to have $460 to start with to purchase raw materials to meet the needs of the next period. This first option, we're not going to be able to pay our employees at the end of that 60 days. We did not generate enough cash, even though we had higher margin. So how much period cash do you need to generate? That's what you have to look at your real numbers and see how much period cash you need to generate. Then you have to figure out how you're going to generate it. How much throughput can you generate for each of your different products or services that you have, and how long does it take you to? And you might have to create a market offer around maybe reducing your price for a shorter cash-to-cash cycle time. And I'm not necessarily suggesting that you do that, but what I am suggesting is that you understand these real numbers. Let's get real. Let's understand what's really happening. So, Mark, any ahas on that one?
Yeah. Do we know enough yet to figure out what to do, or are you going to show us what to do next?
I'm going to outline what to do, but to give you kind of a heads up.
Yes, or a headline.
A headline. Okay, so there's a couple things that you should do. One is that what are the real period costs? So you should do that throughput accounting statement for you. And that's going to be for like a month, a typical month for you, or you could do it for a year. But you have to say, what are my real costs, both my period costs and what's the cash I need to generate the sales I'm estimating. So first step is get real. Really understand what those real costs are for you. Now, if you're looking at that and you're going, oh my gosh, I need to generate more sales than I think I can to meet those period costs, then you have to start looking at your cash-to-cash cycle time. You've got to figure out where that cash is going to come from. And that's what we just did here. So by product or by service, you're going to say, well, how much throughput do I generate for each of those, and how long does it generally take me to do that? And you might create an offer around one or all of your products or services to help you generate the cash you need for the period. But I've got a slide in here that kind of takes you through the steps.
Okay, beautiful.
Okay, so the net of this, the net is the fastest way to increase your cash flow is to decrease your cash-to-cash cycle time. And the reason that you see your cash to in black and the other ones in yellow is that because if you're a service company, you don't really have cash-to-cash cycle time. In other words, if you're a service company that doesn't have to buy something to deliver your service, then you just have cash cycle time. If you're a product company, then you have cash-to-cash cycle time. So the fastest way to increase your cash flow is to decrease your cash-to-cash cycle time, and that is faster than even increasing your throughput.
Wow.
So
Let's see it.
Yeah, so here's the deal. This was the example that we just went through.
Right.
In option 1, where we were going to generate $100 in 30 days, the velocity was 3.33. That was the throughput divided by the cash-to-cash cycle time. In option 2, the velocity, we were only generating $85 in throughput, but we were getting it in 10 days. So the velocity is 8.5. So money's good, but the speed of that money is more important when you're close to a cash constraint. So not only are we, the dollars, when we went through that example, we were at over $6,000 compared to $500. The dollars were 5 times bigger. The cash velocity is also much better. So you have to ask yourself, what do I need to do to cover my period costs and to cover the cash I need for my sales? And some things to consider might be taking discounts and or factoring. You can also think of this the other way. So I'm talking about what you might do. It's also what you could offer. So for many of the people who've heard my presentation know I also talk about mafia offers that are so good your customer can't refuse it and your competition can't or won't offer the same thing. Well, if you have customers in this situation, you can now potentially create an offer that would help them improve their cash.
Wow.
So you can use this on either side, either for you and or for your customers, or how about win-win and how about for both?
Let me give a question headline to this slide.
Okay.
What a lot of Vistage members are facing right now is having to cut prices to survive or to make deals. What you're saying is, with this factoring in the velocity and your true costs, that you may actually increase profitability by dropping pricing if you know what you're doing.
Yes, could be.
Okay.
Or if it's really not, if you know, and I'm also saying if you know your customer well enough that it's not the reduced price they need, they really have a cash issue, give them terms.
I see. And keep your pricing in your terms. Okay.
Yeah, charge $115, but tell them they have longer to pay. So depending on your cash situation and theirs, I'm saying use it on both sides.
Oh, I see now. Okay, now that makes sense. Good. Thanks.
Mm-hmm. Okay, so here's the next steps, Mark, that you had asked for.
Okay.
What do you go do? Well, the first thing is you have to stay clear of the cash constraint. Okay, this is number one. What do I come in and do tomorrow? You have to make sure that you're staying clear of this cash constraint. And how do you do that? Here's what we talked about today. We said, understand what your real break-even numbers are. And there were two. One was your operating expense. What operating expense do you need for each period? Those are your payroll costs and all your fixed costs. What are those each period? What's that nut you have to crack for each period? I usually look at monthly. And be real. Let's get those real, true numbers. Then the next thing, once you understand that real break-even, you can back into the sales you need to generate that break-even. And then you have to say, how much cash do I need for those sales? So we've got what is your real break-even? What cash do you need to cover the truly variable costs so you can sell your product or service? What's the real period cost that you need to cover? And what's your cash velocity by product or service by customer? So in other words, as you start to say, okay, if I'm not generating enough cash to cover my period costs, and I'm not generating enough cash to cover the truly variable costs for the sales I need, then you've got to do something. And what I would do is I would look at your cash velocity by product or service by customer and see where an opportunity might be. Where is it that your cash velocity is way slow? In other words, your cash-to-cash cycle time is way too long. and where can you potentially go make an offer. And the most important thing that I can leave you with is to focus, to absolutely focus. If you don't come in tomorrow, if you're worried about a cash constraint and you come in tomorrow and do anything other than this, that is not focus. And when I need to get something done, when I focus, I turn off I don't look at email. I don't even have it so I can hear the little sound when emails come in. Turn off the email, turn off the phone. This is your livelihood. You've got to get this figured out. You have to understand the real story. What do you need? Now, once you do that, once cash is not going to be an issue, that you stay clear of that cash constraint, then you're going to be focusing on other things. Once you've got that system down, then what I recommend is you develop your Mafia offer. Because most likely, once you stay clear of this cash constraint, the next constraint we're dealing with is this market constraint. And I did a Vistage podcast on Mafia offers, and since we don't really have time to cover that today, what I suggest is everybody go and listen to that Vistage podcast on Mafia offers that was done in January of 2009, and it'll give you an idea of what I mean by that. But the next order of business should be saying, okay, how do I tackle this market constraint? Once you know what your Mafia offer is, typically before you can go out and make the offer, you have to improve your operations to be able to deliver it. Mafia offers, by the nature of them, because they're something the competition can't or won't match, you usually have to change something internally. You're making some improvements internally to be able to deliver the offer. If you could make the offer tomorrow, so could your competition. So there's usually operational improvements. Now, once you have a great offer, you've improved your operations so that you can actually deliver on the offer, then of course you're going to take market share and buy competitors. And if you're in a good cash position coming out of this recession, there's going to be all kinds of deals out there. You can take market share. You can buy competitors. I have one client right now, even in this time, doubled the size of their facility, and they're a manufacturer. And they just doubled the size of their facility, and they're taking market share. They have a great offer. They improved their operations so that they can deliver it. None of their competitors can even meet the offer, and so they're in a great position. So the key is, again, staying focused. What's the one thing you should be doing? Right now, it might be staying clear of the cash constraint, and after that, what's your Mafia offer? And again, the thing about theory of constraints, it's not the 80-20 rule, it's the 99-1. What's the one thing you should be focused on tomorrow when you come in? And you should know that for every day.
Give me give me 3 examples of the one thing we could focus on that we may not be.
Okay, so the first one is I would come in tomorrow and calculate your break-even, which means you have to understand what your operating expenses really are and calculate your break-even. So what's your real break-even? That was the number one thing on my next step. That's what you do tomorrow.
Okay.
Once you get that, then you're going to say, okay, that's my break-even. How much cash do I need for it? How much cash? What am I forecasting in sales to meet that break-even? So for that break-even, it says I have to sell X amount. All right, and how much cash do I need to sell that X amount? And then how much cash do I need for those period costs to cover it? If you don't know what those numbers are, and you don't have the real numbers, I probably wouldn't be sleeping that good either. So the first thing is get real. Get real, get the real numbers, focus on that. That's my recommendation. If you don't have this cash issue, then I suggest maybe your customers do. And I would then look at it from a market offer potential. What could you offer to the market to help relieve your customer's cash situation? So create a Mafia offer around their cash situation.
Okay. Good. We got a ton of questions sent in to us, and in one way or another, you've answered some of them. But what I want to do is I want to go over them and get you to remind us of how these questions could be answered, or go back over some of the ideas you gave to us as a bit of reinforcement, because this is a lot. That you've given us a lot. It's all extremely digestible, but it's such a different way of thinking about things. That the P&L is one thing, but it's not what's really happening.
Right.
All right. Billy H., who's in a CE group, says, where do I find the cash to get me through the next few months while I continue to reduce my overhead, but I want to stick with my marketing plan, which will provide a good ROI. So if he had watched the whole thing, he might have had a different question now, but based on what you've been through with us now, let's give a further answer to this. Where does he find the cash? He's reducing overhead, but not fast enough to get the cash, and he wants to stick with his marketing plan, which will work.
Right. So I would look at this cash-to-cash cycle time. So he's got a marketing plan, and for that marketing plan cost is going in operating expense. So he has to ask himself, do I have enough cash to fund my marketing plan? And if he doesn't, it sounds like he may not, or at least has that concern. First of all, get the real numbers. Maybe the real numbers are a different story, and he could be better off than he thinks, or he could be worse off, but get the real numbers. Look at, if you have included in your operating expense that marketing plan, you're going to fund it by the cash-to-cash cycle time. So what is your cash-to-cash cycle time now, and what could you do to reduce it? So if you want to fund that, then I would reduce your cash-to-cash cycle time. The cutting operating expenses is that to me is the last resort. And I know in this economy it's quick. It is a way to cut your fixed cost, your period cost very quickly. But the downside to it is you can only cut operating expenses so much, and then you're really out of business. So I would say be careful cutting operating expenses, because here's what happens. Let's say that you figure out a way to reduce your cash-to-cash cycle time, but you're also cutting people. Well, at some point, if you're going to sell more because you're reducing that cash-to-cash cycle time, but you don't have enough people to now deliver, you're going to be in a bad way. And so I would say before you go cutting people, get the real numbers and look at your cash-to-cash cycle time and say, first, can I cover who I have now before I let people go? Once you know that you can cover who you have, then, okay, can I cover this marketing plan? And the cash-to-cash cycle time is where you're going to be able to generate the funds to do that. Outside of that, if you cannot generate it yourself, then you may not be able to do the full marketing plan. Then I would pick the pieces of the marketing plan that you think are going to have the biggest return. Assuming that, of course, you can't get a line of credit, you can't get a loan to do the marketing plan, then you're going to have to pare down on the marketing plan. And I would prefer to pare down a little bit on the marketing plan than to cut people.
Well, I want to follow up with that, because there's Jane Gale B. who's in a CE group. She asked a question, she didn't know you were going to be saying it this way, but her question is, we have reserve funds. What's a prudent percentage of those reserve funds to keep versus cutting staff? Now, I know what you're going to say, but if you could explain why. In other words, there's money in the bank, and do I hold on to that money or cut staff?
Okay, and I would say, well, it depends. Do you have a good offer? Okay, if you're approaching this as, well, we've cut back, we're not marketing anymore, we're not maintaining our sales, then your profits are gonna go down, obviously. So I'd say my answer is that the good consultant answer, it depends. If you can create a good market offer that you know is going to enable you to go out and take market share. And to do that, you need to be able to do what you said you were going to do when you said you'd do it. In other words, when you give a customer a commitment that we'll have that done for you by this day, you need to have the staff to meet those commitments. See, the problem is that when people cut staff, they can't meet their commitments anymore, and they don't deliver when promised. And in this economy, the last thing you want to do is not do what you said you were going to do. They can go find somebody else. There's plenty of people willing to cut prices. So you're going to differentiate yourself by doing what you said you were going to do. And a lot of my clients, part of our Mafia offer is offering guarantees. So we'll ship on this date, and if we don't, we're going to deduct 25% per day late. Well, the competition has cut people. They haven't improved their operations. There's no way they can meet that offer. They think we're crazy for doing it. So if you have a good offer, and you can go out and take market share, don't cut people, because that's going to take you the wrong direction. That's what everybody else is doing. Everybody else is cutting people. Everybody else is getting worse on their commitments. If you can create a great offer, get better on your meeting your commitments, you should be able to take market share. And why would you want to cut people?
Wow, what a truly, this is the opposite of what we've been hearing for really the last 15 months or so. Everything's been cut, and you're saying figure out where you are,
yes,
and figure out the best offer, and that's the way to get out of your jam.
Yeah, and if you can't come up with a good offer, then by all means cut. We need to survive to fight another day. So if you don't have an offer, you can't get an offer, or you have an offer but it's not moving fast enough, and you need to cut to survive, then by all means do that. But make sure you understand the real number. Those numbers were quite a bit different.
Sure.
So just make sure you have the real number.
Dorian R., who's in a key group, says with businesses all over trying to do the same thing to each other to achieve the same goals of maximizing their cash flow, what are one or two things we should be doing now to rise above the rest or to be distinctive?
So if your customer, so it depends. If you're close to being a cash constraint, you have to look out for your cash flow. But you can oftentimes simultaneously also look out for your customer's cash flow. Let me give you an example. I have a client who sells labels, several clients who sell labels, and it's one of the Mafia offer examples I give. Well, their offer initially was the more labels you buy, the lower price per label. So they use something called the price quantity curve to sell the labels. So you want to buy labels from us and you want to get the best price, you got to buy a bazillion labels all at once. Now, look at that from your customer's perspective. First of all, you're going to spend a lot of your operations time producing a big load of labels that they don't even need all at once. And from your customer's perspective, they're tying up a ton of cash for labels that they don't need all at once. So think of it both, not only from your cash, which I agree is extremely important, and you do need to live to fight another day. Start to look at it from your customer's cash position and create a win-win. All good Mafia offers are win-win.
Very good. All right, Dr. Lisa, we need to start to get into wrap-up mode now. This has been incredibly eye-opening, the different way to look at things. I want you to one more time, if there's one thing that we can leave with, and not only one thing that we can leave with, but we can go back and look at this, because all of this webinar, like all Vistage webinars, are archived. Go back and look at it time and time again, and many Vistage members do that. They go back and look. But as you leave us today, leave us with a glimmer of hope. Can this be done? Have you seen your clients do this successfully? Okay.
I walked into a client on a Monday who did not have the cash to make payroll on Friday. We made payroll on Friday.
Wow. And are they still around?
As far as I know.
All right.
That was a couple of years ago, so I sure hope so.
All right. Lisa Lang, who's joining us from Golden, Colorado right now. She's the president of the Science of Business, just a tremendously insightful way to look at what cash really is and how to figure out what it really is. Thank you very much for hanging out with us, answering our questions, and taking us methodically through this and giving us a great bit of understanding.
My pleasure, Mark. Thanks.